market watcher Anthony Saccaro.
Anthony Saccaro here to help us is Anthony Saccaro, president of Providence Financial and Insurance Services.
Anthony, thank you so much for being with us.
Providence Financial's Anthony Saccaro is with us.
Anthony, what are you telling your clients who are in that position?
We're in the middle of a very long-term secular cycle. And if you're depending on that money, you're depending on the interest, you're depending on that, you're over 50 years old, you're going to need that in retirement, the rates will not move. They're going to stay down for a long time. I think Japan's a good example of that.
Well, there's a whole universe of income producing options. So we do have a lot of our clients in stock. A very small percentage right now. Typical client might have 20 or 30% in stocks. And if we have another recession and the stock market goes down another 10 or 15 or more percent from here, I want them to be able to buy more. So dividend stocks is absolutely part of the equation.
If you can live off of your portfolio at a 3 or 4 or 5% interest rate and not lose money the next time the market crashes, then that's what you should do.
You need to be able to invest so that no matter what happens, whether it's good, whether it's bad, you can still accomplish your dreams and goals.
See your articles in the USA Today, Forbes, Wall Street Journal. I mean, you're everywhere, man.
Well, good evening. I'm Anthony Saccaro. Thank you for joining us for our Friends and Family webinar. I'd like to say quarterly Friends and Family webinar, but I've been a little remiss in actually doing it quarterly. But certainly glad to have you here. We try to do these webinars periodically just to answer your questions and keep you informed of what's going on. And so I can do anything I can to just help you and let you know my thoughts and concerns as we move forward through the market. So we got a lot of good questions from you. We do these for our clients. If you're a client, thank you so much for your business. Thank you for your trust. You know that we don't take it lightly. If you're a friend, if you're the friend part of that Friends and Family webinar, then thank you for joining us. If at any time you want to get more information, feel free to visit our website, providencefinancialinc.com. And you can get more information from us that way as well too. So a couple of things for the visitors that we have. We have quite a few people on board and a lot of names that I don't recognize. So I'm a couple things. I'm founder and president of Providence Financial and Insurance Services located in Woodland Hills, California. I'm also founder and president of Anthony Saccaro Law. We do estate planning. So that's the law firm that I have that's in Granada Hills, California. And I'm also host of the Providence Financial Retirement Show, which airs every Saturday and Sunday morning on AM KNX 1070. So 6 o'clock Saturday mornings, 7 o'clock Sunday mornings. And for those of you that are frowning, like, what does he got to be on so early for? Good news is we have a podcast and we replay the radio show on our podcast. That's available Monday. You can go to providencefinancialpodcast.com and or search for the Providence Financial Retirement Show on your favorite podcast player, and you'll be able to then listen to any of our past episodes. I think we're coming up on 400 episodes. So everything having to do with retirement, everything having to do with helping you have a stress-free and the peaceful retirement you deserve. That's why we exist. And a part of the way we do that is through education. That's why I do the radio show, the podcast. That's why I wrote the book, More Life Than Money. So that's why we do these webinars. So what's on tap for, however long we need? I'd like to think we'll be 45 minutes or an hour. But if you know me at all, you know that it takes me about a half hour to say bless you if you sneeze. So I tend to be more thorough, and using an economy of words is not my strong suit because I'd rather over-explain than under-explain. So let's talk about what's on tap. We're going to talk a little bit about the current economic environment. Then we're going to talk about what the Federal Reserve is going to do. And ultimately, are we going to have a recession? Those are what we're going to talk about. And then we're going to answer your questions. I'll probably spend first 10 or 15 minutes addressing those things. And then I'm going to answer your questions. We got a lot of good questions. I've got 7 of them written down, but there's some questions within questions. So we'll see how that goes. Answer your questions along the way. Now, if you want to ask a question, you should be able to see a Q&A in the chat box. or somewhere on the right of your screen should be able to see Q&A, and you should be able to type in a question. So don't hesitate to type in questions as we go. But I am going to try to keep it to an hour. I think that's going to be a hard stop at 7:30 as well. So that being said, let's talk a little bit about the market. We had a hiccup in the market a couple of weeks ago, right? Market dropped 8%, and it's amazing how many people were worried about, oh my gosh, is this it? Are we starting a recession? It's like everybody got jumpy. Now, not you. I have to be very clear. Well, none of you. We got 0 phone calls. I was checking with Chuan. And we got no phone calls, and you shouldn't be concerned about an 8% drop. But in talking with other people outside, it was a very jumpy situation. The fact is, though, that when it comes to the current economic environment, the market has been so strong for so long for a couple of factors. The primary factor that's being talked about, and then there's a factor that's not being talked about, something that's kind of going on behind the scenes that's important. So what is being talked about? Well, inflation until 6 months ago has been a primary driver of the Federal Reserve's decisions, right? The Federal Reserve has 2 mandates. What are they? They're to keep inflation under control, and they're to make sure that there's full employment. Well, employment has been in the full employment range for several years now after we recovered from COVID. That's not a problem. So it's really the inflation part of their mandate that they have to address. So with the inflation part of their mandate, their goal is to try to get it under 2%. And they have never done that. And yet it's a mistake to wait until they get to there to actually make a move. They have to make a move before they get there because inflation is a lagging indicator. What that means is that whatever happens today with inflation is not going to show up for 6 months. So if they wait for the actual inflation number to get to 2%, it's too late. They had gotten caught with their pants down when they said before that inflation is transitory. Bottom line is that they don't want that to happen again. So when inflation seems like it's coming down, that's when they're going to make a move. Well, what has kept inflation up has been the labor market. Labor market's been very strong. COVID kind of kick-started that. And there are people that exited the labor market for a number of reasons. There were a number of government workers, teachers that exited the labor market because they didn't want to get the vaccine. There were a number of private sector workers that also left for the same thing. I know I've got one client that was almost forced to retire. He didn't because he worked for a major Fortune 500 company and he didn't want to get vaccinated. And the bottom line is that he almost was forced into retirement. In his situation, it worked out. But a lot of people were forced into retirement, or a lot of people decided just not to play the game and they decided to retire. So there's a lot of people that have retired. And what that's meant is that there have been more jobs available than workers. And in some of the live TV interviews that I've done over the past years, going back maybe 2 years now, I remember that the number of jobs available per worker never quite got to 2 to 1. So I think the highest number that I remember seeing was 1.9 jobs available per worker, almost 2 to 1. So what that means is that for every worker that's ready to go get a job, there's twice as many jobs available. Well, what this does is this creates employment inflation. Because if there's a lot of demand for workers, the demand side of the equation high, if the supply of workers is low, then the supply side is low. And for those of you that took Econ 101, and it's a simple supply-demand equation. If there's a high demand for workers and a low supply, what's going to happen to the price? Well, price is going to go up. Workers felt like they could go anywhere and get a raise. They weren't worried about getting another job. They could demand the raise of their employer, or they would go find something else somewhere else. So what's happened is across the board, employers had to increase wages just to make sure they weren't losing workers. And if they were growing and wanted to hire people, they had to pay more. I'm an employer. I went through this. I can tell you that the wages for all of my staff are through the roof. Now, I don't want to say they're making too much. They're not making too much. They're making what they're worth. You guys that deal with my staff, you know we've got good people. That's because we pay them well, we take care of them, and they take care of you. But the reality is when they raise minimum wage, as they've done, when wages go up, where does that ultimately get passed on to you? Well, I guess that was a bad question, right? It was the question and the answer at the same time. Where does that ultimately get passed on? And the answer is to you. Now, we haven't done that, by the way. Okay, so we haven't raised our fee. Our fee structure has been where it is ever since I started business. We've just never restructured it. But the reality is that it gets passed on to you. And so there's some parts of inflation that can be controlled. Commodities are going to go up, they're going to go down. Groceries are going to go up or going to go down. And yet wages are going to go up, but they can't go down. It would not go over well if I sat down with one of my team members and said, hey guys, the inflation part's over. And yet I gave you a, big raise last year, but now that inflation is going down, I'm going to take that away. That just wouldn't fly. So there is, inflation has come down, right? The last reading of inflation, 3%. But the inflation that we've already incurred, I think it's 21% inflation over the last 3 years, if I'm remembering my numbers right. The inflation that we've already occurred, that's not going anywhere. That's the problem. So some people will say, well, is this inflation, going to stay? Well, the old inflation is going to stay, and the new inflation, it gets down to the level that they want. The reality is that you're never going to get rid of that old inflation. So we are in new times. But the labor market is a big part of that inflation number. And the labor market is it's weakening. And that's the whole point. As long as the labor market's strong, then the economy is going to be strong. And I said years ago when we were going through this, same thing. Other economists, other professionals have said the same thing. It's all dependent on the labor market. Well, the labor market's softening. Right now, there's only 1.3 jobs available per worker. So that number is more in line with what's been historical. And the unemployment rate is up. Unemployment rate is now 4.3%. It's been under 4% for years. And now it's at 4.3%. So that's good. That's good. All of that shows that the economy is softening. And that's what you want. You want the economy to soften, because if the economy softens, then you get inflation under control. Now, the Federal Reserve then is on target to lower the interest rate by 0.25%. In financial terms, 0.25% is 25 basis points, 25 bips as they call it. So it's 0.25%. And that's all but priced into the market at this point, that they're going to lower in their September meeting. I think it's the 14th and 15th, if I remember right. They're going to lower interest rates by 25 basis points. So that's something to keep in mind. What impact that's going to have, I think we'll talk about that in just a minute. But the question then becomes okay, well, are we going to have a recession? Well, we don't know, right? It's been this recession that's never come. I thought we were going to have a recession 2 years ago. As a matter of fact, most of the economists thought that we were going to have a recession 2 years ago. But it's been said that, economists have correctly predicted 7 of the last 2 recessions. Some of you guys will get that later. But the reality is no one knows, right? We get asked that question all the time. What's going to happen? Well, if we knew, then we could tell you, then we'd be rich. But the reality is that when you turn on CNBC, when you turn on Fox Business, when you turn on Bloomberg, you're going to just get different opinions. And sometimes you'll hear one opinion, and the next opinion you hear is the exact polar opposite. But what I can tell you is that we're not out of the woods yet. Okay, what I can tell you is that we could still have a recession down the road. There's a couple of reasons, a couple of kind of signals that indicate we could have a recession. One is the negative yield curve. The second is that we've had a consumer confidence index report that's been negative, and an expectations index report that has been negative as well too. So let's talk about the negative yield curve. A positive yield curve slopes up. A positive yield curve, is going to be particularly relevant to anything that's going to pay you income, fixed income. And a yield curve is usually attributed to a bond or a CD or something like that. So what a positive yield curve says is that the further out you go, the more interest you're going to make, right? That's the way it's supposed to be. So think about this. If you're going to buy a 10-year bond, what would you expect to pay you more interest, a 10-year bond or a 1-year bond? Yeah, the 10-year bond, right? So what would you expect to pay you more interest, a 10-year bond or a 30-year bond? Yeah, 30-year bond. The farther out you go, the more interest you're going to make. Well, starting in May of 2022, I believe. So now we're over 2 years now. We've had a negative yield curve, and a negative yield curve goes like this. A negative yield curve says that the farther out you go, the less interest you're going to earn. Well, why would you commit to a longer time period for less interest if you could commit to a shorter time period for higher interest? Well, it's because the smart money knows that if interest rates go down, Now, you might not even be able to get what you can get today long run, even for the short run. So you're really sacrificing short-term returns for a long-term gain, And that's exactly what the negative yield curve tells us, because whenever there's been a negative yield curve, and there's been a couple of exceptions, not 100% reliable, but more often than not, for sure, it's been a good predictor of the fact that we're going to have a recession. Okay? That's the main thing. So what's our yield curve now? Well, a 2-year treasury right now is 4.07%. Okay, 4.07%. So you can lock in a 2-year treasury bond at 4%, 4.07. But if you lock your money up in a 10-year treasury bond, it's going to be 3.89%. So what is that? 18 basis points, if my math is right. Yeah, 18 basis points, 0.18% difference. You're going to get 0.18% less for locking your money in or locking in an interest rate for 10 years than you would for 2 years. And that's just indicative, has always been a good predictor of recessions. So that's one thing. And by the way, it's not uncommon when you look at a history of recessions, it's not uncommon for the yield curve to flatten out and then become positive again before the recession happens. So it's not just that it's negative and once it flattens out, we're good. Many times it's actually flattened out and got back to normal before the recession has happened. And we've seen it flat. We've seen it flatten out. Right now, there's only an 18 basis point spread. The highest I remember seeing it in the last couple of years, I remember seeing the 2-year, I believe at 5 and the 10-year at 4. So there's 100 basis, like a 1% spread. You get 1% less for committing your money to 10 years than you would for 2 years. So, and it's all because of where we think, or where the bond market particularly thinks the stock market is going to go. And a negative yield curve seems to predict that we're going to have a recession. The Consumer Confidence Index is also something good to look at. There's 2 parts of the Consumer Confidence Index report. The CCI. The CCI basically takes consumers' expectations of today. How do they feel about today? And that's been going down. That's been negative. But there's a small subset of the CCI report that's called the Expectations Index. And the Expectations Index is where do consumers see things in the next 6 months? And that's, for now, a couple of years, it's been below 80. Well, it's a big deal. Well, anything above 80 is good. Anything below 80 has always signaled a possible recession. And again, it's not as accurate as the negative yield curve. But when you look at the negative yield curve, that signals a recession. You look at the expectations index that often signals a recession. You put everything together, and it just basically says that a recession is not we're not out of the woods yet. Recession is not off the table. So, the first thing that we said we were going to talk about is, why is it that the market's done so well? We talked about the labor market a little bit. The labor market's been strong. That initially pushed inflation. Prices are now coming down because the labor market's weakening. We have unemployment of 4.3%, so it's on the higher side. We have inflation now 2.9%. So everything's going in the weakening direction, which if you want inflation to come down, that's the direction you want it to go. But it's all been really primarily tied around the labor market. For the first year of COVID, it was supply demand, supply chain issues. That's all gone, though, for the most part. Okay? But there's something else that I think that doesn't get talked about at all. I have never heard it talked about, but it makes sense when you think about, well, why has the market done so well? It's not just because of the labor market, but it's also because I think the psychology of Americans and starting to think that stocks are a safe haven. Stocks are not a safe haven. You can lose a ton of money in the stock market. And yet we tend to be biased, what's called recency bias. We tend to be biased towards what's happened recently. And for the last 13 years, the market's just gone through the roof. Well, and that's normal. That when you study history of the market, right, there are long periods of time where there's no growth and long periods of time where the market does really well. But what hasn't got talked about is part of the reason why I think the market recovered from COVID as fast as it did is because the Federal Reserve printed trillions of dollars. And now we're at like $35 trillion in debt. So the fact that we almost had a crash, well, we had a crash, but the fact that we recovered from that crash and within 6 months, the market went down 40% within just a month and a half. And within 6 months, we were back to record highs. And the reason why that happened so fast is because the influx of cash that the Federal Reserve put into the system to keep the market from crashing. So what they told us psychologically is you don't have to worry about it. We got your back. So if people think that stocks are a safe haven, and if people think that we can't lose money in stocks anymore, and the stock market does 9 or 10% a year on average, why would you not put your money in stocks? We're $35 trillion in debt. The fact is, at some point in time, it's going to catch up. It can't stay this way. So there could be some problems ahead. We just don't know. And one of the things that I've been saying on TV recently, I think it was 6 months ago that I said it the first time, it just kind of flowed out of my mouth. The question, it was Yahoo Finance. The question was asked, in today's world, with wars going on, with interest rates, not knowing what the Fed's going to do, with inflation out of control, geopolitical events, how's someone supposed to invest? And my answer was, you need to be able to invest so that you can win no matter what. Win no matter what. And if you're invested right, you can win no matter what. Every now and then we'll get a question from someone that says, hey, my portfolio with you is getting 5 or 6, but the stock market's gone up, 20%. And it's almost like, well, but we have to remember, it doesn't matter what the market did. It matters what you can or cannot afford to lose. The market can go down by 50% at any moment in time. It's gone down by 50% twice in the last 25 years. And, I lived through these times. I lived through the 2001 crash. I remember people that in 2000 wanted to retire in 2001 and 2002, but their portfolio, their 401k had been turned into a 201k and they couldn't retire. And that didn't recover until 2007. So now all of a sudden, wanting to retire, anxious to retire, looking to retire, they're 65 or 70 years old, and now they got to wait for their stupid portfolio to come back, and then they retire, and it costs them time. And there's this time-money dynamic that, at some point in life, time becomes more important than money. When you're in your 20s and 30s and you're trying to make rent and you're eating grape nuts, right? It's all about the money. You're going to live forever. It's all about the money. But when you get into 60, 70, years old and beyond, what's more important? Is it more the money or is it more the time? And now all of a sudden, if we have a major crash, the market's going to come back. But now you have to wait for that to happen. And now you're giving up the most precious thing you have is time. If you're planning on retiring at 70, it's a very common retirement age these days. 70 is probably the new 50 or 55, really. But if you're planning on retiring at 70 and the market crashes when you're 69 and then you're 70, the market's down more. Now you have to work till 75 or 76. How much time did you give up of your good years? If you're 70, maybe you have 120 months left. Maybe you have 180 months left if you're, lucky to have good years all the way through your mid 80s. But now all of a sudden you got to give up half that time because the market crashed. It becomes more important to be invested right than about the returns on your money. And maybe in the stock market, you could have earned 20%, but what else could have happened? You could have lost. If you can't afford to gamble, you should not sit down at the machine. That's the bottom line. And my goal is to help protect you a lot of times from you. And the market's done really well, but the market still can go down at 50%. It's gone down 50% twice in the last 25 years, once in 01 and once in 08. I lived through 08. I can tell you the stories of people that in 2007 wanted to retire in 2009 and could not retire because their portfolio had been cut in half. And we can see it coming again. I just don't want you to get caught up in that. And most of you don't need to. So I digress. But the bottom line is that we could still have another recession. We don't know what that looks like. I don't think it's going to be hard. But it doesn't matter. If you're invested right, then you're going to win whether we have a recession or not. If you're invested for income, you can count on your 5 or 6% every year. And it doesn't matter whether we have a recession. If you're invested in the stock market and we have a recession and the market crashes, it might cost you your retirement. And I don't want you to be able to retire and win only if the market does well. I want you to win no matter what. I don't want your future to be dependent on what the market does. And a lot of people out there, that's exactly what's going on. A lot of your friends, that's exactly the position that they're in, but they feel like it's okay. They feel like, well, the market always goes up. Yeah, in the short run, but sometimes what they forget to tell you is that the market goes up in the short run, and it might just be making up for a major crash that just occurred, because there are long periods of time where the market's been flat. I mean, in history, the last period of time that we had where the market was flat, and I feel like I'm way off base, so we're going to move on, but the last period of time where the market was flat was from 2000 to 2013. 2 crashes, 2 recoveries, no growth for 13 years. But you realize that that was the shortest, what I often refer to as secular bear market in history, because there was a long period of time, 16 years in history. There was one time, 16 years, where there was no growth in the market. There was one time period in history for 20 years, there was no growth in the market. And there was one time in history for 25 years, there was no growth in the market. 25 years. Now, if I asked you before you knew the answer, and you guys are all clients, so I feel like I'm speaking to the choir, you guys would probably all say, yeah, we knew that because we read your book and heard your radio show and podcast. But for those of you that are guests that maybe haven't heard me, if I would have asked you before, has there ever been a time period, has there ever been a 20-year time period where the market has just had no growth? What would you say? I ask this question all the time in live workshops or one-on-one meetings in my office, and the answer is no. I never thought, because the market always goes up. Yeah, it always goes up, but that up might be just making up for having gone down. And they don't tell you that. So, and it's these flat periods of no growth for decades at a time, followed by good periods of great growth. And if you look at history, just from a purely standpoint of history, the fact is that the first 13 years of this century, no growth in the market at all, 0. The last 14 years, straight up, the market's done 15% plus. So if history repeats itself, bad time period, good time period, bad time period, then the reality is this recession could be kicking off something that's larger, something where the market's just going to go up and down and go sideways for the next decade or so. And that would be the concern I would have, is that I just don't want you to have to participate in that. If you're invested for income, you don't have to participate in that, because you can count on your income every year. So, so that's, so is there going to be a recession? I don't know. If I had to guess, I'd say yes. I think it's going to be mild. I don't think it's going to be major, but we don't know. But here's the answer. I don't care. And if you're invested wrong, and whether we have a recession or not depends on what you're going to do in retirement, or whether or not you can retire, and you're going to have to keep working. If we do, you're invested wrong. If you're a client of ours, it doesn't matter whether we have a recession or not, because you're living off your income. You're living off your income. So I don't really care if we have a recession. And the media makes it sound bad, like recession's bad, the R word. You got to avoid recession. No, they want it to slow down. So on one hand, they're saying you want the economy to slow down. On the other hand, they're saying we don't want a recession. What they really don't want is they don't want a horrible crash. They want a recession, but they don't want a horrible crash. Recession is often a psychological state. They don't want it to become self-perpetuating, because if you think there's going to be a recession, you're going to sell your stocks. You sell your stocks, then the market's going to go down and more people are going to sell, and it becomes this snowball, and it becomes this psychological effect where it becomes a self-fulfilling prophecy. And that's what they don't want to happen. So they're saying they don't want a recession. They really do want a recession. They just don't want a horrible recession, but they do want a slowdown. Slowdown and recession are essentially the same thing. So it's not that they're talking out of both sides of their mouth. It's just that they don't want a major recession. So I had said that I'd kind of open up with 15 minutes. It's now been 30 minutes. So let's jump into some questions, and we'll see what we get. So I've reworded some of these questions. I've combined some of these questions. We got a lot of the same question that I kind of put all together, and I've kind of boiled it down to, what do I think? I think I have 7 questions here, but and so I don't even know who asked these questions. And again, some of them have been reworked that asked the question the way that you did. So let's do it this way. We'll just read them. Given the current economic climate, which seems to be characterized by fluctuating interest rates and economic uncertainty, what adjustments should I consider making to my investment portfolio? Okay, good question. We get that question a lot. So the answer is it depends. You're going to find that that's the answer a lot. First of all, when we are working with our clients, it's not uncommon for us to have a small percentage of stocks in the portfolio. There's a couple of things inside our clients' portfolios that are good inflation adjusters. Stocks are one. Real estate investment trusts are another. REITs are pretty tricky right now, so we're just not putting a huge amount in your portfolio. But stocks, most of you have somewhere between 10 and 30% in stocks. And so the idea that I've been talking about for several years now is, with the market as high as it's been and running up, is what I want you to do is have some stock in your portfolio. It's a good inflation adjuster, but I don't want you to have so much stock in your portfolio that you're afraid to put more later. I want you to be able to win no matter what. And a lot of times what that means is, let's put some in a good methodology that we use is, let's figure out what is the maximum amount of stock you should have in your portfolio at any point in time. So, some of you might be saying, well, 50%. Some of you might be saying, 20%. But whatever that number is for you, maybe you should have half of that number in stocks now, so that if the market continues to grow and we don't have this recession we're talking about, then you've got some access to the market. You're going to win because you've got some stock in the market. But on the other hand, if the market does go into recession and we do have another major crash, then you didn't put so much in the market that you can't invest more, that you're scared to invest more. So now you can put more into the market. You can double up. So in my book, that's really winning no matter what. Now, when we talk about stocks, when you're investing in stocks with us, what we're really talking about is we're talking about dividend stocks. If we put 100% of your portfolio into dividend paying stocks, you're going to yield like 4.5%. So it's not income or growth, because of the expertise that we have being income specialists, and because of sound income strategies behind the scenes that does that money management for us, being income experts. When we put together a portfolio of stocks, it's going to be high quality stocks, value stocks, and at the same time going to pay you a dividend. So it's growth and income. So when you ask the question, what adjustments should I consider making to my portfolio? If you're a client of ours, you're probably where you should be. Tuan and I work together literally daily to make sure that our clients are where they are. So if you've dealt with Tuan, you know how phenomenal he is. He's been a financial advisor for 17 years. So we've probably got you tweaked to where you should be. But based on what I've said, if you don't have anything in the stock market, it might not be a bad time to get something in. Or if you want to wait, if you want to gamble and bet that the market is going to go into recession and put more in at that point, that's okay too. We just don't know. But I think making sure that you've got something in stock, dividend paying stock, and something in or enough in other things to where you can add more to stock later, I think that that probably makes sense. Number 2, how does a rate increase or decrease affect my annuities with American Equity? Okay, great question. It's not just American Equity. It's how do they affect index annuities at all? We work with American Equity a lot. And the reality is they're a great company, and I work with them unless there's a reason not to. We have the ability to work with any insurance company out there. I like to work with one company that I just know inside and out, and that would be American Equity. But some of you have some other annuities out there for reasons that are just going to be different, where maybe American Equity just didn't make sense. So it doesn't matter whether it's American Equity or whether it's any other annuity. It's the kind of annuities, the fixed index annuities that you have. How does a rate increase or decrease affect those annuities? Well, annuity companies make money based on spread. Most of the annuity investments, and it does vary from company to company, but American Equity has a lot of real estate, but American Equity and most other insurance companies use a lot of bonds. And so what happens is they make the difference in the spread. So when interest rates are high and they can invest for a longer period of time and they can get a higher interest rate, well, then they can pay you a higher interest because they're getting a higher interest. So they're going to make whatever that difference is between the spread. If they're getting 7-8% on their investments and they're paying you 4 or 5%, then they're making 3-4% on their entire portfolio. That's how they make money, is based on the spread. Well, if interest rates come down, then what's going to wind up happening is they're going to make less money because rates have come down across the board. And oftentimes when rates come down, they have to lower their caps. They have to lower caps. They have to lower participation rates. They basically have to change the formula to compensate for the fact that when rates come down, they're going to make less. So that's generally how it's going to affect you. Now, behind the scenes, you might say, well, wait, I thought my index annuity ties my rate of return to the stock market. Well, it does. But the reality is that they don't invest in the stock market. The stock market is used as a gauge to determine how much interest you get. but their actual investment is not in the stock market. It's going to be in bonds or real estate or something else. And that's where they're going to make their money. Now, when interest rates have gone high, what it's done is it's given us the ability to upgrade your annuity. The last year, I actually think it goes back to about October, November of last year. So about the last year, the interest rates were high enough. They have gotten high enough to where the annuities could actually offer formulas behind the scenes and pay more interest than I've seen in like my 25-year career of being an annuity expert. So what we've done is many of you, I would hope all of you have been contacted by Tuan to see if it makes sense to upgrade your annuity. Even if you have a penalty, a lot of times what we've been able to do, because rates are so high, companies can pay more. Companies can pay a lot more now than they could just 3 years ago. And so what we've been able to do a lot of times is be able to take someone out of one annuity, put them into a different annuity. And depending on what annuity you got and why you got it, most of the time you would get more income. And because of the bonus that a lot of annuities offer, you would have a higher account value to start with. It was a win-win all the way around. There's very few things in the financial world that are black and white. Most of them, most everything is shades of gray. And there's a balancing act. There's pros, there's cons. Well, with this, there was no balancing act. It would have been silly not to do some of these things. So I know Tuan's been on a feverish tear for the last year to call you. I know he's upgraded a lot of your annuities. If you're out there and you haven't had your annuity upgraded, call Tuan. And it doesn't have to be an annuity we did for you. It could be one we did for you. It could be one that you got from somewhere else. But if you haven't updated your annuity in the last 3 years, call Tuan, let him look. You might be missing just a phenomenal opportunity. But guess what? That goes away when the Federal Reserve lowers rates because the opportunity goes away. So we've had this 1 year window and it started already. The Federal Reserve, the 10-year Treasury was at 4.98%. It didn't quite hit 5. I want to say 2 months ago. And now the Federal Reserve is going to lower rates, and it's the 10-year Treasury is at 4% now, 4 point something, very low fours, but it's come down a lot at this point. So hopefully that answers your question about the annuity. Next question, should I move my money into T-bills now? I don't want market fluctuation. Okay, great question. We get this question a lot. And so there's a couple things you need to know. First of all, we talked about the inverted yield curve. We talked about the fact that, right now, the farther out you go, the less you're going to earn. We talked about the reasons for that. But what a lot of people have done, the mistake that a lot of people have made is this. They don't understand that inverted yield curve, and they lock their money up for 1 or 2 years at maybe 5 or 5.5% instead of locking their money up at for 9 or 10 years at maybe 4.5%. Okay, that's a mistake. Here's why. Because in 2 years, when your 5.5% CD matures, if the Federal Reserve lowers rates, and right now it's predicted that they're going to lower rates by 200 basis points over the next couple of years. If they do that and your CD that you've been getting 5.5% matures, you might not even be able to get 1 or 2. But if you'd have locked in a higher interest rate at 4.5 or so on your own, by the way, okay, 4.5, now you're still getting 4.5, even though that short-term CD would have gotten you a larger yield, but only for a shorter period of time. Okay. So when you think about assets and liabilities, okay, there's an asset column and there's a liability column. And what you want to do is you want to make sure that you match up short-term assets with short-term liabilities and long-term assets with long-term liabilities. It's a mistake to mismatch those. So a CD, a 2-year CD is going to be a short-term asset. You've locked the money in for 2 years. You're feeling happy for 2 years, but it's a short-term asset because you only locked the rate in for 2 years. Well, if you're going to need the money in 2 years, if you have a short-term liability, great. That's what you want to do. If you're going to use that money to buy real estate, you're going to use that money for college, wedding, whatever you're going to use it for, you need a chunk of money in 2 years. Yes, short-term asset, lock it up for 2 years, get that rate for 2 years. And then in 2 years, when the CD matures, you're going to have the money available for when you need it. It's great. But most of you, or most, not you, again, your clients, but most of the people that call in off our radio show or people that are coming in to see us that are not clients, what they're doing is they're making the mistake of taking this CD, this short-term asset, but it's not for a short-term liability. It's for their retirement. And retirement, what's that sound like? Does it sound like a short-term liability or a long-term liability? Yeah, it's a long-term liability. So now they put their money in a short-term CD, but that money is really geared for a long-term liability. And what they're probably doing is shooting a hole in their own boat. and don't even know it. So it's a mistake. So the reality is, the question is, the question you're asking is, should I move my money into T-bills now? You didn't say short term or long term. I kind of take the implication to mean that it's going to be short term. Maybe not a bad idea to lock in rates for higher. But I wouldn't necessarily use T-bills. And here's why: because at Providence Financial, when you work with an income specialist like us, the fact is that we can, right now, with rates where they are, we can get you 5 or 6% almost just as safely, or maybe even safer, or just as safe as a T-bill as well too. And right now, T-bill is going to be around 4%. You could get 1 or 2% more than that for just as long of a period of time. So I don't know that that's a great idea, as far as the T-bills is concerned. Again, but short-term asset needs to be matched up with the short-term liability. Long-term asset needs to be matched up with a long-term liability. Hopefully that makes sense. Oh, so let me see. What's the next question? Do I have any questions too, by the way? You guys aren't asking a lot of questions. I don't see any questions over here. So feel free. I think there's a Q&A that you can click on and ask questions. I'm more than happy to get those too, but let me keep going. What's the next question? I've heard you discuss Roth IRAs on your podcasts, and I'm now considering a Roth IRA conversion strategy to manage future tax liabilities. Could you elaborate on the factors I should consider when deciding whether to convert traditional IRA assets to Roth IRA, including how this might impact my current and future tax situations? Okay. Long question, however I put it there, but IRA to Roth IRA. Well, first, it's important to have a basis as far as what's IRA mean, what's Roth IRA mean. Well, a traditional IRA is where you put money in, you save taxes when you put it in, but it's going to be taxable later and you're going to be forced to take it out. So you're going to put money in now, delay taxes until a later time, and then you're going to take money out, whether you want to just spend it or whether it's because of required minimum distributions, and now you're going to pay tax later. That's a traditional IRA. Roth IRA, you put money in now, but you pay the tax on what you put in, but it's going to be tax-free for later. Okay. So a Roth IRA conversion, there's a lot of individuals that have said, well, I wish I could have done Roth IRAs before. They didn't start till the mid-90s, so some people were able to do them, but some people missed the boat or missed a good portion of their career was before that, before they retired. So what you can do is you can take and convert an IRA to a Roth IRA. What you're going to do is you're going to pay the tax on the time that you make the conversion. And that's the number one reason, right? People don't pay the tax. The number one reason is people look at that and go, oh, I got to pay the tax. Okay, well, you're going to have to pay the tax at some point in time. The question is, would you rather pay the tax when the government tells you to on their schedule, or would you rather be proactive and pay the tax on your schedule? So you're going to have to pay the tax. And by the way, where are taxes going? Are they going down or are they going up? Yeah, they're going up, right? We know that they're going to go up. So if they're going to go up, taxes are on sale today. Why not pay tax at a lower rate today than when they go up in the future? So it's not a bad idea to start thinking about some conversions from a traditional IRA to Roth IRA, pay the tax, and then that Roth IRA, because you paid the tax on that money when it went in, that grows tax-free forever, 100% tax-free. So the bottom line is that's not a bad strategy at all. Now, there's a couple of misconceptions that oftentimes people have, and a lot of these calls come in off my radio show where I can understand really what the misconceptions are. One of the misconceptions is it's all or nothing. I've had people, send me an email that will say, hey, I love the Roth IRA idea. I just have too big of a IRA. I'll get killed on the taxes if I convert my entire $1 million. Well, yeah, but you don't have to do all or nothing. You can do it. You can do a little bit at a time. Many of you are on Roth conversion strategies and you're doing a little bit at a time. Some of you are doing it over 5 years, just depending on the size of your IRA, your tax brackets, everything else. Some of you are doing it over 10 years. And so you don't have to do it all at once. Matter of fact, most of the times it doesn't make sense to do it all at once. You also don't have to do all of it. So you might only need to really convert 50% of your IRA. Now, some of you want to convert everything, and that's okay. We look at that, but a lot of times it's not even necessary. You can still be really tax efficient by just converting half of your IRA to a Roth IRA. So I think the things to think about right now is not only the short run, but the long run. It's a short-term pain, if you will, for a long-term gain. And while taxes are low, it seems to make sense to pay taxes at a lower rate than it does to wait until later and pay taxes at a higher rate. So The tax bracket's something to think of. Required minimum distributions, that's something else to think of, because you have a required minimum distribution on your traditional Roth IRA or your traditional 401k. You do not have an RMD ever on your Roth IRA, ever. So now if you have a lot of money in your IRA, your pre-tax retirement account, and you don't need it, you don't want it. I find that to be true, by the way. I find that most people that have sizable retirement accounts is because they were responsible. They did well. And then when they get the retirement, they don't really need it. They don't want it. It's not a part of their habit. They're used to putting money in. They're not used to taking money out. And so they pretty much leave it there and let it grow until they hit the age of 73. And if it's sizable, the RMDs are going to be sizable, and you're going to get killed in taxes with the RMDs. And if you just wait, then that's what's going to happen. And by the way, you cannot convert an RMD to a Roth. That would be a golden opportunity. The government's not that nice. So you can't do that. But if you were to set up a strategy to start doing some conversions before you get to age 73, then you can really dramatically lower your RMDs, which then means lower your taxes later. So not a bad idea to do that, because you don't have to take RMD from Roth IRA. So it does let you control your taxes a little bit more from that standpoint. Another thing is your beneficiaries. There's a rule that the Secure Acts of 2019 and 2022 changed the rules with regards to your beneficiaries. They now have to take an RMD over a period of 10 years. And some of your beneficiaries have to take an RMD every year for 10 years. Some of your beneficiaries can actually wait the entire 10 years and then take the whole thing. Usually not a good strategy for traditional IRAs, because if they wait for 10 years, they take the whole thing. I mean, you're going to get killed with taxes. And of course, it depends on the size of your IRA. It's not true, if you have a $30,000 IRA. But with the Roth IRA, the RMD rules still apply. They still have to liquidate that Roth IRA by the end of 10 years. But because there's no RMDs on there, they can wait till the end of 10 years, let that Roth IRA grow for 10 more years after your demise, and then take the whole thing as a lump sum, tax-free. So you pay the tax now, you get tax-free growth forever. You don't have to take RMDs during your lifetime, and then you leave it to your beneficiaries and they can let it grow for 10 more years tax-free. That's not a bad deal. But the number one reason why people don't do it is because, I got to pay the taxes. Okay, well, you're going to have to pay the taxes at some point. And the question is, when do you want to do that? Do you want to do that when the government tells you to, or do you want to do that when you choose is best? So don't poo-poo them. And we've worked with a lot of you on that. If that's a question you have, if you're not sure, whether or not you should do Roth IRAs, let us know. Call me, call Twan. We'll certainly walk you through the scenario and see if it makes sense for you. And by the way, it doesn't make sense for everybody. So just to be clear, because I know some of you are probably watching this go, hey, they told me it doesn't make sense. It doesn't make sense for everybody. I just think a good chunk of the time it probably does. Okay. Well, let's move on. Hopefully that answers your question. Here's a question. Is there a way to roll over real estate sales proceeds and gross rents into a product that yields the same monthly rental income? So I think what you're talking about is getting out of real estate completely. And it's not uncommon for someone to want to quit being a landlord. I have this conversation probably a couple times a month where someone, will call me up and go, look, I got this place. Someone moved out. I'm tired of being a landlord. I couldn't charge rent during the COVID period because rent was abated, and I'm just done. And so what do I do with the money? So we've done this a lot. And so the important thing to think about, though, or what I should say, is that it's not uncommon for you to be able to sell your property, pay the capital gains taxes, and pay the realtor fees and all that, and then take the money and invest it for income and still be able to earn the same amount of rent. Still be able to get the same amount of income from that portfolio than if you had owned the real estate. So that's not uncommon. Of course, it depends on what the value of your property is. It depends on what rent you're charging. There's a lot of factors that, are not going to allow me to answer your very specific question, but it's not uncommon for you to sell real estate and then replace the income with investing with assets that are designed to give you income. Now, that being said, there's a couple of negatives. There's a couple of cons, and that is that real estate gives you good tax write-offs. Whether that's a big deal for you or not depends on your situation. So you'd probably want to check with your tax person to see, what it's going to cost you tax-wise. You can depreciate your real estate, right? And your real estate grows over time, and it's inflation adjusted because you can increase your rents. I like real estate. If you had to ask me, what is the number one thing that you should do with your money? I think real estate. But you can't do real estate with an IRA. Well, you can. I would not recommend you do it. There's lots of downfalls. But if you've got big retirement accounts, that's not going to work. But the point is, I like real estate. I think it makes sense for all the reasons that we talked about. But at the same time, the big side, the downside, you got to be a landlord. And you get in a call that, I've had clients tell me that I had one client recently say they called me because they had a bat in the house. And so at midnight, they're over there chasing the bat, right? And if then it's the typical toilet, and you could hire what do they call that, maintenance company, or I'm forgetting the word, but to manage the real estate. You could hire a company to do all that, but now you're eating into your profits. So if you don't want to be a landlord, yes, there are a variety of ways to replace that income, and you do it by investing for income, just like we're doing for those of you. So I think that answers your question. Hopefully that does, to the best I can. What's the next question? Let me take a sip here. I feel like I'm talking a lot. You guys feel like I'm talking a lot? I'd love to ask if this has been helpful, but I can't hear you. Can't see you shake your heads, but hopefully it's helping. We could pay off our debt now. Wait a second. I'm missing a word. We could pay off our now, but it would lower. I think the word debt should be in there. Okay. We could pay off our debt now, but it would lower our emergency fund. We owe about $97,000 on the home. It's worth $1.2 million. Should we pay it off? The only debt we have is the $5,000 car loan. Okay. So the car loan you should pay off. But $5,000 is just a few payments away from being paid off anyway, probably. The mortgage is a little bit different. Your home's worth $1.2 million. You own $97,000 on it. I'm going to only assume that you refinanced this sometime in the past few years, and you're probably at a 3% mortgage rate, somewhere there. So what I don't know is how much is in your emergency fund. If you have $97,000 in your emergency fund and there's $97,000 owed on the home, and you use that to pay it off, then you have no emergency fund anymore. Probably wouldn't do that. Probably wouldn't make sense. But if you have a couple $100,000 in the bank and you want to use $100,000 of it to pay off the home, it might not be a bad idea. My general thought is I like debt-free. Okay, I like the bird in the hand. When we do your planning, I want to do the planning on the guarantees. I want to do the planning on what we know we can count on, not what we hope we can count on. And so the reality is that, I defer from a lot of my other financial planning counterparts when it comes to paying off the debt, because I think you should pay off the debt. And the conventional wisdom is that from most advisors is that why would you pay off your $97,000 debt? Your interest rate's only 3 or 3.5%. You could get more than that. You get 7, 8, 9% on your money. It doesn't make sense to pay off the debt. And that's what they tell you. But I don't so much agree with that, because my philosophy is I want the guarantees. Yeah, you could make 7, 8, or 9% on the money, but if you've got that money in the market, what else could happen? You would lose 7, 8, or 9%, or you could lose 20% or 30% or 40%. I like the bird in the hand. This is where sometimes I wonder whether the advice you get is really in your best interest or whether it's in the advisor's best interest. If the advisor tells you, hey, take $100,000 out of our portfolio that we're managing for you and we're charging you a fee on, and go pay this debt off, they're going to lose money. And I just don't. So they make it sound good as well. And yet it does sound good. But the reality is I like having debt free. So if you have enough in the bank, you have a couple $100,000 in the bank that's just sitting there, and you want to write a check for $100,000, fine. Absolutely. I don't know what your income is. I don't know how big of a deal it is. I would almost be more inclined to say, you know what, just make some big payments at it. Why don't you make it a 2-year plan to pay it off? And then that way you're not taking a huge chunk. But ultimately, I think it's a great goal to have it paid off. And if you're not retired yet, it's a great goal to have your mortgage paid off by the time you get to retirement. So hopefully that helps. I don't have all the information I need, but feel free. It's a specific question. Feel free to call us, talk to myself, talk to Twan. We'll dial it in for you. 2 other questions in 5 minutes. Let's see how we go here. We're seriously looking to retire to Prescott, Arizona. Well, first thing I'll say about that is go visit Prescott now. Okay, it's what's 115 out there or something like that. So go stay out there for a week and then come back and talk to me. Okay, now actually I don't know about Prescott. Maybe it's a little cooler in Prescott, but I do know Arizona's hot, right? So you want to move to Prescott. Property tax is about half of what we pay in Huntington Beach. Oh yeah, you're probably in good weather in Huntington Beach too, right? I feel it's a financially good decision. Do you have clients with similar issues? Yes, we have lots of clients moving out of California. I don't get me started down that road. The politics behind it, the property taxes, the expense. Yeah, we have a lot of clients moving out. I've got more clients across the country than I've ever had because they're moving out. Seem to be moving to Tennessee. Tennessee's a common area. Nashville. No, not Nashville. Yeah, Nashville, actually. Tennessee's a common area. Idaho, I've heard, cold in the winter, but some people don't mind. Texas, another area. So, yeah, I do have a lot of people that are doing that. It is going to be a lot less expensive, and you can buy a home for, what, 1/3 of the price that you can buy a home here for. So it's not uncommon for someone to cash out of their home. It's actually not even uncommon for someone that doesn't really have a lot of savings. They might have a $1 million or $1.5 million home and not a lot of savings, maybe $250,000 over here. And now they can sell their home. They walk away with $1 million. They spend $300,000-$400,000 on a home that is on much more acreage, much bigger, in a different place where it costs them less property taxes, less living expenses, and now they put another $500,000 or $600,000-$700,000 in investments, and now they get more income. Life is good when you're in that situation. So yeah, we have a ton of clients thinking about that. If you want to talk that through, just again call me. I'm not sure who asked the question, but feel free to call us. We'll talk you through that. We get those questions a lot though, and yeah, there's your answer. What else? Last one. Last but not least, we'd like to know more about the life insurance with the long-term care rider rates that you've been talking about for a 57-year-old male and a 53-year-old female. Okay, so this is a good topic to end on because it's something that I probably haven't promoted as much as I should. So I'm going to take this opportunity to do that. In my book, I talk about what's called asset-backed long-term care. I'd like to tell you what chapter that is. I don't remember what chapter. I feel like it's chapter 7 or something, but I don't know. But I talk about something called asset-backed long-term care. I've been a long-term care expert for 25 years. When I started in the industry 25 years ago, I really started by being a long-term care salesperson. And I won't drag you through that whole history. I'm just pretty familiar with long-term care. But it got to a point within a couple of years of my career that I quit selling it for a lot of reasons. There were just some things I learned about it that I just couldn't sell it. I've always asked whenever I go to make a big decision for myself or for a client, really for clients, would I do it for my mom? And within a couple of years of selling long-term care, I was like, no, I wouldn't do this for my mom. So I quit selling it. Some things I learned, but it's grown and it's changed over time. And so what's developed now are policies that are long-term care policies and life insurance policies at the same time. And that's morphed into what's called asset-backed long-term care. And the long and short of it is this. The way it works is you take an asset, which is the asset-backed part of long-term care. The asset's cash, one or 200,000. If you want to get more coverage than necessary, maybe 300,000. But most of the people that are doing this is somewhere between $100,000 and $300,000. And what they're doing is you take that asset and you transfer it to an insurance company. So let's say you transfer $100,000 to the insurance company. Well, what you need to know is that it's a transfer. You didn't buy anything. If you spent that $100,000, you don't have the $100,000 anymore. But if you take that $100,000 and just transfer it to the insurance company, it still stays on your balance sheet. It's still your $100,000. It's just like if you took $100,000 out of one bank and put it in the other bank, it's still your $100,000, still yours. Same thing, still yours. But what that does, though, is that's going to give you two benefits. It's going to give you a death benefit. So if you die, then that $100,000 is going to be increased to some multiple, depending on your age and health status and so on. You're going to get more than that for a death benefit. So if you die, there's going to be a tax-free death benefit that goes to your beneficiaries. But if you need long-term care, it's also going to cover you for long-term care. So those are the two benefits that you're going to wind up getting. Now, for the long-term care, there's an additional premium, but that premium is really low compared to what a traditional long-term care policy covers or what a traditional long-term care policy is going to cost you. It's really, really low. And the benefits are really high. Why? Why is it that you can transfer money and make a lower premium payment, but get a higher benefit? Because actuarially speaking, most of you are not going to even blow through the money that you put there. If you transfer $100,000 to the insurance company, the reality is that most of you are probably not even going to spend your own money. So the insurance company's not even on the hook until you get through your $100,000. So it can give you higher benefits and they can give you lower costs. And it's actually pretty nifty. When you look at long-term care stats, long-term care is very expensive, right? The average for California is well over $150,000 for home care, for long-term home care, very expensive. But the statistics that the averages are very interesting. I don't want to make up numbers, but I want to say that it's close, even though if I'm not correct, something like 80% of everybody that goes into a nursing home, right, or needs full-time health care, something like 80% of those people die within like 6 months. So then in that situation, you didn't even use your balance. Insurance company didn't even spend any money because you didn't even go through your 100 grand yet. But out of the people that live longer than 6 months, something like 80% of those people live longer than 5 years. So you're either a real short time or a really long time. The average across the board is about 3.5 years, but that's where they come from. Averages can be misleading, and this is kind of one of those situations. If we knew you were going to die within a year, you'd never even need the insurance. You just pay for it out of your own pocket and you're good. But there are a lot of people in nursing homes today that have been there for 5 and 10 years. Just go visit one. And you'll see. The reality, though, is that having this long-term care insurance feature covers you in case you're going to live a long time. And it does it for a lot less expensive than you would think for the reasons that we just talked about. There's only a fraction of the people that are going to outlive their $100,000. But if you happen to be in that fraction, then you could be leaving your spouse in a very dangerous situation to not have any money, even though, when you pass away. And I just hate seeing that happen. I've seen it happen over my career multiple times where one spouse will need long-term care and then they spend all the money and maybe they go on Medi-Cal or something and then they die and the surviving spouse doesn't have anything left. Not a happy scenario. So this solves that. So the asset-backed long-term care, you transfer the asset to the insurance company. It stays on your balance sheet. What does that mean? It means if you ever want to change your mind, you can always change your mind and get the money back. Just like you can transfer it back to the bank. Now, you're going to lose insurance if you do that, right? But you can always get it back. So it's still your money. But if you need long-term care, you're going to have a higher long-term care benefit. And by the way, that benefit goes on forever as long as you need it. So it's not capped like a lot of the older policies. And if you don't ever need long-term care and you pass away in your sleep like you hope, well, then you didn't waste all that money because there's a death benefit that now is going to go to your beneficiary. So they're actually pretty nifty. I don't get excited about insurance, but if there's any insurance to get excited about it, it would be that kind of insurance. So hopefully that answers that question. And actually, even just throw this out there and then we'll call it a wrap. But even just in the last year, there have been some annuities out there that have actually come out with some really nifty long-term care benefits that is almost hard to believe that they exist. But the reality is there are some annuities. There's alternatives to this too. And if spending the money, maybe cash is tight, you can't afford, a few extra $100 a month or an extra $500-600 a month for long-term care, whatever it works out to be for you. If you can't afford it, then an annuity might be an option with the long-term care benefit too. So anyways, that answers that question, hopefully. And if either one of those you want to learn more, just call us, email us. But let me see. I think that's going to do it. So again, for those of you who are clients of ours, truly appreciate your business. We don't take it lightly. If you're a guest and this is the first time you've seen me, again, thank you for joining us. You can get more information about us at providencefinancialinc.com. If you forget that, just search for Providence Financial Woodland Hills. We come up all over the place. You can learn more about us. And for those of you that have never listened to my podcast, even our clients, go back. Look at the podcast. Go to providencefinancialpodcast.com. There's 400 episodes. You're probably going to scroll down. You'll see the titles and click on one you like, and I'm sure you'll learn something that you didn't learn before. My job at Providence is to help you have a stress-free and peaceful retirement. And I truly hope that you've learned something here that has made that more of a reality than it was before we started this Q&A. So thank you for watching this Q&A, and call us if you have any questions about anything you learned. God bless.